Okay, moving on to our next group, angels, devils, and their agents. So these are people who are looking to make investments in the world. And I want to start with a critical distinction between what are called accredited and non-accredited investors. And it's important to understand that this really occurred after the 1929 financial crisis, when the SEC, the Securities and Exchange Commission, was established to protect general investors from investing in areas that they don't understand well or taking on more risk than they can afford. So that's when we got this definition of an accredited investor, and the details of what makes someone accredited change over time, right, including with inflation. And you see some of these on the slide. What's important to understand is there's a belief, there's a correlation that wealthier folks are presumed to be more sophisticated than less wealthy folks, which means that they have more opportunities to invest. They're less regulated in their investment choices than what are called non-accredited investors, or what I'm going to call community investors. So I'm going to come back to the accredited investors in a moment, but I actually want to really dive into what the investment opportunities are for non-accredited investors, community investors, or what are also called retail investors. So first of all, they most often are limited to investing in mutual funds and other public equities that have a high bar for transparency and reporting requirements. And the SEC protects these investors by applying restrictions on their choices, like they can't invest in hedge funds and private equity funds and venture capital funds. There are more disclosure requirements and there are more documentation requirements for funds that are open to non-accredited investors. And that is one of the things, for example, when Boston Impact Initiative said it's really important for us to be able to be open to community investors, it required a whole special set of filings in order to allow our fund to include community investors. But there is a whole category that has opened up in recent years beyond mutual funds and public equities, which is crowdfunding. And crowdfunding is the process of raising funds for an enterprise by inviting many people to invest small amounts of money. And until 2012, when Obama signed the Jumpstart Our Business Startups Act, which maybe you didn't know the name of, but that's actually the Jobs Act, the only kind of crowdfunding that was permitted until then was rewards and donations, right? So you had websites like Kickstarter and Indiegogo where you could have a t-shirt in exchange for your donation, but not investment capital back. Or a nonprofit like Kiva, where you could make a donation to Kiva and then do interest-free lending on the platform, but you're not allowed to make money on the investment. So that was allowed up until 2012. And then the Jobs Act created an affordable legal pathway for small businesses to raise investment capital from anyone, not just accredited investors. And this is what's often referred to as regulation crowdfunding because it's regulated by the SEC. So unlike donation crowdfunding, regulation crowdfunding does allow businesses to raise debt. They can raise equity, they can raise royalties, safes, lots of different types of capital. And there's a couple different buckets of how they can do this, right? So Reg D, Rule 506C, we're into legal regulatory stuff here, allows businesses to advertise investment opportunities broadly, meaning to the public, but it's restricted to accredited investors. So it is a form of crowdfunding, but again, you have to be accredited to do it, and they can raise as much as they want using Reg D. We're really interested in Reg A and A+, and Reg CF. So Reg A+, which is a variation on Reg A, businesses can raise money from accredited and non-accredited investor, but there are limits to how much they can raise each year, right? So there's a tier 1 level, which is a $20 million level, and tier 2, which is a $75 million level that was added in 2021. And then Reg CF, you can raise money from both accredited and non-accredited investors. And they, again, in 2021, increased the $1 million limit up to $5 million. So again, there are fewer regulation and reporting requirements for Reg CF than there are for Reg A+. But still, the SEC has set limits, and there are limits around the amount that you can invest. So if your annual income or net worth is less than $107,000, you can invest up to the greater of either $2,200 or 5% of the greater of your annual income or net worth during any 12 months. Okay, it's not important what the details of those are. Essentially, what's important is that, again, the goal is to try and ensure that non-wealthy investors aren't throwing their money away into investments where they're going to lose everything. And it's an interesting question. Is it true that non-wealthy investors are less sophisticated than wealthy ones? I think that begs inquiry. And there are lots of ways to learn about crowdfunding, regardless of how much wealth you have, and become quite sophisticated about it. One of the things about crowdfunding is it does have to be done through an SEC-registered platform, something like you may have heard of WeFunder or Republic or Mainvest, or through a broker-dealer. So crowdfunding can be a little expensive for the enterprise in terms of the legal filing, and it's a big marketing strategy to go out there and raise capital. It's often advantageous for what we consider to be B2C businesses, a business-to-consumer business. So somebody like a local brewery that we invested in, going out and raising money from the public who they hope will be their customers and also own a share of their business. But it can be useful also for B2B, for business to business. And so this whole movement toward crowdfunding and saying, let's raise small bits of capital from many, many, many people means that we're distributing the risk much more broadly. And we're also distributing the opportunity to create investment return and to build relationships between enterprises and many, many people in their local communities. So I think it's a great opportunity for both enterprises and community-based investors to explore.